Company. I'm Nicole Bako, your host. I'm an IRA specialist at Quest Trust. And today, monitoring for us is Kurt Powers, another IRA specialist on the team. We're so glad to have you with us today. And today, our special guest speaker is Ryan Gibson. Before we get to our topic and the man of the hour, let me just share a few slides about who Quest Trust Company is and what exactly we do. So give me just a couple seconds to share my screen. All right, I want this one. Start from beginning. All right, guys, should be the right one. Am I the right one? Doesn't look like it's on there. It doesn't look like my second screen's hanging. There we go. Okay, sorry about that. All right, so welcome to Self-Directed Saturday. Who is Quest and what do we do? So we are the largest IRA custodian in Texas. We have this is probably just a slightly outdated. We have over 20,000 active investors invested with us across the country. So we are able to do business in all 50 states. So no matter where you're joining us from this morning or this afternoon now that we're officially at noon, you are able to do business with us in all 50 states. So a huge asset there. We have $2 billion under assets under administration. So Quest is actually a custodial firm for self-directed IRAs. Our clients find their own deals, do their own due diligence, and come to us, and we act as the custodian and help facilitate those transactions. We have $350 million in undirected cash, allowing more opportunities for doing private deals, is like private lending and promissory notes. Our disclaimer, these presentations, along with all of our presentations, are for educational purposes only. We do not provide any tax, legal, or investment advice. This is just for education only. So be sure and contact your legal, your attorneys, and your CPAs before making any of your investments, making sure you're doing your own due diligence there. All right, so what is a self-directed IRA and why should you have one? So self-directed is honestly just a marketing term. It just means that you're in the driver's seat and you direct us on what you would like to invest in. So an IRA at Quest is really no different than an IRA at anywhere else, short of the platform of the large diversification of things you get to invest in. So the assets that you get to invest in at Quest are all privately held, so nothing publicly held. It would be advantageous for you to have one. So it does allow for that further diversification. So instead of just being able to invest in stocks, bonds, mutual funds, you get to invest in privately held investments like real estate, promissory notes, and private entities. Opens it up for syndication for multifamily, LLCs, limited partnerships, things like that. So it opens up to a whole new world, things like oil and gas. So a lot of diversification there instead of just kind of what we're used to with the stocks, bonds, mutual funds. Tax savings, so like in the form of a traditional IRA, all of the earnings and income are tax deferred, meaning you pay taxes when you take those distributions out at retirement. Of course, the magic age being for the IRS is 59.5. Or a Roth IRA, you have the opportunity to build up that wealth and potentially have tax and penalty-free distributions at retirement. Make sure to contact an IRA specialist to see how these can work for you. We have several plans that do have these tax savings. We'd love to tell you more about that. We don't have tons of time in this just little intro today. Social investing. Not everybody can get traditional mortgages, let's say. So doing so through the form of a promissory note is some way to help people to do so. So social investing is another advantage. And of course, investing in what you know best. If you know a lot about real estate or promissory notes or oil and gas or even cattle or horses, we have things like that as assets in our some of our clients' portfolios. So it really does open up the doors for lots of different possibilities that you might not have known about. So definitely get in touch with our IRA specialists, and we'd love to tell you more. So type of self-directed accounts. Here at Quest, we have 7 different accounts broken down in our 3 categories. Our personal plans, including those traditional and Roth accounts I was talking about earlier, those employer plans and those specialty plans. You see there's 2, our health savings and our education savings accounts. I'd love to tell you more about all these plans more today, but we're limited on time. Again, make sure you get in touch with us, our IRA specialists. We'd love to tell you more about how these accounts can help you and your family get closer to savings on retirement for these. Investment choices. Honestly, this kind of looks like a long list, but it really is short compared to what you can do in these accounts. And these really don't even list the oil and gas opportunities that are out there as well. So again, make an appointment with our IRA specialist, and we'd love to tell you more about how these might be able to work for you. So the day is coming upon us for the 2020 contribution limits. It's May 15th for the rest of the country. If you do live in Texas, we have a little bit more time. It's June 15th. So we wanted to put the slide in there to let you know what the 2020 and 2021 limits are for the different type of plans we have. So again, contact those IRA specialists. We'd love to help you set up a new account if you don't have one already to get the contribution started, or help you decide how much you have left to contribute for 2020 or 2021. We again offer endless free education. So like the one you're sitting in now, we have plenty others. So our YouTube channel is really, really robust. Our marketing team really has been putting a lot of work into that. The webinar you're watching right now is actually streaming live. Will be recorded there, and you can watch it later on our YouTube channel. So Kurt, I know, is going to put all the links to that in our YouTube, our chat box for you to see all that. Our education center on our website has plenty of articles and webinars you can view as well. We also have weekly webinars on Tuesdays and Thursdays at noon Central for you to see. We have our virtual networking happy hour on the first and third Wednesday of every month at 6:30 Central. This is a great networking opportunity, also a fun event. Everybody has a little time to shine in the sun, get some time on the camera to share kind of what you're doing. If it's a real estate deal, or if you're a lender or a borrower, you kind of say what you're looking for. And we now have investors able to, now that it's virtual, really join us from all over the country. And it's official as of 2 weeks ago. It has gone international. So please join us. If you kind of don't know what you're looking to do just yet in your account, or if you're looking for investment funds, etc., it's a great place to come and see kind of what other people are doing. And then there's a conversation section at the end. So great opportunities there. And of course, our self-directed Saturday, which you're attending right now, every Saturday here at 12 noon Central. So our special for the month, May, this is through May 17th. If you open a new account between now and then, we are waiving our $100 account opening fee with the code TAX-FREE in the coupon code section of the fee schedule. So again, contact those IRA specialists. I'll put that information, it'll be on the screen in a second, and I know Kurt's putting it in the chat box now. So huge opportunity. If you've been looking to set up an account, now is a great time to do so. We have a summer intensive coming up in July. This is the first time we've ever done this. You can see the different topics we'll be talking about: oil and gas, multifamily, so real estate lending, promissory notes. So lots of different topics being covered. This is one of our few paid education events that we do have through the year, but $25 does cover all 3 of these dates. So this is going to be a really exciting event. So make sure you check out our website and sign up for this event. And how to get in touch with us. We're actually really easy to get in touch with. So this QR code actually does work if you put your cell phone camera up to it. Chat with us live. If you've ever been on our website, the chat box comes up on the right. These are not robots. It's actually real people. I'm on there on Wednesdays. I think Kurt is on there on Tuesdays. So it's actually us that you're getting to talk to. give us a call, 855-FUN-IRAs. We do our very best to make this a fun and exciting adventure for you. Or email us directly. Our main email, iraspecialist@questtrust.com. My email, nicole.baco@questtrust.com. And Kurt, I know, is going to put his email in there as well. Kurt.power@questtrust.com. So make sure you get in touch with us. We'd love to help you get started. Even if you have an account with us, we'd love to help you kind of see where you need to be. So without further ado, now you know how to get in touch with us. I know we'll put that again in there. Throughout the presentation, you can put your questions in the Q&A box, and we'll try to get those answered for you at the end. So without further ado, we're going to have the man and the topic of the hour, Mr. Ryan Gibson.
Hi, thanks, Nicole. Appreciate the nice intro.
Thanks, Ryan. We're so happy to have you here.
Yeah, likewise. Looking forward to talking about one of my favorite topics, self-storage. So
awesome. Well, we can't wait. All right, Ryan, take it away.
All right, thanks. All right, we're going to go ahead and get started. Everybody can see my screen, I assume. If not, let me know. Well, my name is Ryan Gibson, Chief Investment Officer for Spartan Investment Group. And today we're going to talk about the recession-resistant asset class, self-storage. And specifically, later in the presentation, we're actually going to dive into a case study of 4 facilities that we purchased in Tyler and Longview, Texas, last year in 2020. We're going to talk about how we structured the capital, some operational improvements that we're doing to drive value and increase NOI and produce a return. We're going to talk about how those properties were folded into our portfolio and how we really provided a lot of value to that. But for those that don't know storage, it might be an unfamiliar topic, or maybe you've learned a little bit about storage before. One thing I like to point out is that there's more self-storage facilities than all of the Starbucks, McDonald's, and Burger King locations combined. So if you actually look across all of the data, there are actually about 60,000 self-storage facilities in the United States. And if you tally all the Starbucks, McDonald's, Dunkin' Donuts, and Pizza Huts, and even the Wendy's, you still don't have as many self-storage facilities in the country. But before we go into storage, I really just wanted to kind of give a high-level overview of kind of why we got into storage and maybe some of our past experience. My company is Spartan Investment Group. We started the company in about 2013. And I'm the co-founder, and Scott Lewis is our CEO. There's our team on the bottom left there. Our headquarters is in Golden, Colorado. We also have an office in Seattle, Washington, in the Westlake area, primarily for acquisitions and for capital raising. Last year, we were recognized by Inc. magazine as one of the fastest growing companies in the United States. We were specifically the 8th fastest growing privately held real estate company in the US. About 1,400% growth from 2017 to 2020. And we're very excited that we've almost doubled that growth from 2018 to 2021. So looking forward to the results of the Inc. 500 this year. We operate our self-storage facility portfolio under the Free Up Storage national brand. You'll see on the right-hand side there, that's our Free Up Storage national brand. So we rebrand all of the properties that we buy, and all the properties that we build, we brand in our Free Up logo. A little bit about the business. We've got about 7,000 units spread across 5 states currently, 43 full-time employees. We have about $150 million portfolio currently, 200 active investors, individual investors investing in either private debt or private equity that we offer, 50 million in total private funds raised. And we've had 10 projects go full cycle. And we have currently about 17 or 18 projects active in our portfolio now. So how I got started in real estate, that's me on the left-hand side. I have a career formerly as an airline pilot, and that's my daughter on her first flight. And we're headed to Hawaii, actually. And we were going up from Seattle to Maui in the 737. And that's when I flew for Alaska Airlines. My business partner, Scott Lewis, on the right-hand side there in his Army gear, he's a disabled veteran and served in Iraqi freedom in 2009. And the houses in the middle there actually represent how we met. So my house was on the left, the white one. His house was on the right, the green one, with the matching uniform there with his green and brown. And we have the house in the middle, and that was actually our first flip. So we bought that house and gutted it down to the studs and sold it for a profit. And that was our first Spartan deal back in 2014 is when the house sold. And what we really enjoyed about each other's company when we first met was that we had a mission and a goal in life, and that was to improve lives through real estate. So that's actually the mission statement of our company now. And we do that through providing great value to our investors and working with our sellers, and especially now our employees, to make sure that there's a great culture and environment to work in and thrive in and grow. So a little bit about our team. This is our headquartered staff in Golden and Seattle. And we pretty much do all aspects of the business. So we will find the deals, we raise private funds and do syndications under Regulation D. And then we do all the property management. So Free Up Storage is the brand, and then we hire all the staff at the property to run the facilities. And we also have a couple of RV parks and are building a manufactured housing community in Washington now as well. We do the asset management. We also handle all aspects of the development. So we'll take a property through conditional use permitting or a rezone. We'll expand a facility, work with our architect, civil engineer, and then we're also the general contractor. So we have a construction management group within inside of Spartan. And so we carry out all the construction and expansions at our properties. And then lastly, I'd like to point out that we do all the business intelligence. So we will do all the research and feasibility studies and market studies that go behind proving our business plan before we buy a property or build one. So what I love about storage is that there's a lot of it that are a big demand for it in the United States, and it's only growing. And I always joke that like the show, the Marie Kondo show, if it doesn't spark joy, people put it in self-storage on auto pay. Which is a great kind of foray into describing what's created a $39 billion annual industry. So there's about 1.7 billion net rentable square feet of storage in the United States, over 55,000 facilities. And on average, every person in the United States uses about 5.4 square feet of storage when you consider the entire population. About 9.4% of households, and then the average cost of a storage unit is about $87. Storage is becoming consolidated. So this is some recent news here in the industry. This all has happened within the last 2 quarters. Bill Gates dropped a couple billion into StoreMart, and Public Storage recently bought Easy Storage for $1.8 billion, and then even Blackstone entered the market with a $1.2 billion purchase of Simply Self Storage. So there's a lot of consolidation. There's a lot of money that's moving into the market. And storage is kind of a small industry, but it's rapidly becoming consolidated and becoming more institutionalized as we move along. And it's no secret why. The sector has really been recession resistant because the space is based on life events. I love giving the story of how I was on a flight during the middle of the pandemic, and the airports are empty. So you're kind of, there's the people that are there, you say hi, and, I struck up a conversation with somebody and I said, why are you traveling in the middle of the pandemic? And she said, well, I have to fly to Florida to move my mother's belongings into a storage unit because she's moving into a retirement home. So there's a lot of different things that happen that drive storage. And it isn't necessarily an excess amount of stuff, although that is the case sometimes. But there's a lot of business uses and other cases for storage, but a lot of it is driven by disruption in the market. So people moving, relocation, and otherwise life events. And during the last 2 recessions, it was one of the least foreclosed upon real estate sectors. In fact, in 2009, pricing only went up during the last recession. So when we looked at storage, this chart only goes to 2016. We looked at this chart back when we were doing residential development. We were building condos and houses and renovating properties in Washington, D.C. And, we looked at what asset classes we wanted to focus on over the next 5 years. And self-storage really stood out. And we looked at this chart and we saw that self-storage during good times outperformed the S&P 500, all other REITs, by over 300%. So during great times, it does well. And then if you can see as well, it actually outperformed every other REIT during the last 2 downturns. So we like the fact that the storage industry was recession resistant and that it actually benefited from disruptor events, things like coronavirus. So we started getting into it. We took 4 months and we did nothing but learn about storage. We didn't do any deals. We didn't look for any properties. We just wanted to learn because we were already in the real estate space, and we found that these were a lot of the uses of storage: businesses, contractors, sporting teams, home renovation uses, landscaping companies, hobbyists, etc. And it wasn't just about personal use. I would say in our portfolio currently, we have about 30% business use for self-storage. So the other thing that we liked was the 3 E's: easy to own, easy to evict, easy to maintain. So when you build a storage facility, you don't have to worry about toilets, cabinets, appliances, countertops, trim, paint, carpet. There's a lot of great things about investing in storage, and the ease of maintenance is one of them. And we also like the fact that there's low variability in capital expenditures. And put otherwise, we have over 7,000 units in operation, and currently we have about 20 to 25 toilets. So if you think about 7,000 units in a multifamily portfolio, you're talking about 14,000 to 21,000 toilets, depending on the unit mix. We also like the fact that it was easy to evict, and we'll talk about that in just a minute, and the simple construction of it. We wanted to be our own developers. We wanted to have our own construction company. We also wanted to be our own operators and have control over the entire value chain. So we like the ease of operations from that perspective. This is a self-storage kind of comparison across asset class types. So, I get a lot of questions about what's the difference between self-storage and multifamily, and how does that compare to single-family investing or flipping? And I think we all get into self-storage we all get into real estate because it's tax advantage. So the first row there really kind of highlights that, real estate is tax advantaged in general. And I have the asterisk next to flipping because depending on how you structure your company, you can be tax advantaged in flipping, or it could be disincentivized by having big taxable events when you sell flips. The average stay across the different asset class types within real estate are pretty consistent. Our average stay right now is about 58 months in our portfolio. So our customers stay for quite some time. We've got a customer that's been there since 1991 on one of our properties. And multifamily, single family, obviously have long stay length. Economies of scale, if you're trying to scale 7,000 single family homes, it's pretty difficult to do that. So I think multifamily and self-storage kind of start peeling away. But really what makes self-storage different is the automation, rent recapture, and low maintenance. So the automation, to touch on that briefly, at our facilities, you can pull up, you can book on your phone, you can pay on your phone, sign a lease agreement on your phone, upload your ID, and get access to our facility and rent a unit on the spot. You really can't do that in multifamily or single family. It's very labor intensive to lease out a unit. The other thing that you can do with rent recapture, we can get a non-paying tenant locked out of a facility after 3 days automatically. We also can put the customer in the auction process, usually within 30 days, and have them completely vacated from the property within 60. There's a very low cost to do that. And the proceeds of the auction give the ability to recapture the rent that you lost during the delinquency. So we love the auction process. What's interesting about storage is the lease agreements that our customers sign give us the option to lien their belongings if they don't pay. So we can actually auction off their belongings and recapture the rent that's owed. And then the last thing is low maintenance. So when I start, talking about storage, when we buy self-storage facilities, and we'll get into this a little bit more, rents, we look for properties that are under market value in rent. So we go into a market, we try to find the properties that are lower rent than our competitors with similar asset class, structure. So if it's a Class B facility to a Class B facility, we compare the rents and see if we can come in and raise rents across numerous units. So, if you think about it, the average acquisition for us is about 500 units. So 500 units, raising rents $10 a month is a $5,000 increase in NOI pretty much on the day that you take over. So, you ask yourself, is a tenant going to move for $10 a month? And the answer is usually no. About 7% of our customers move out when we raise rents. And it's really hard to pin down if they're moving out because the rent went up or because it's typical turnover. So, ask yourself, if your rent went up in your self-storage unit and you really needed storage, would you go move all your stuff for $10 a month? And would you move all your stuff if the competing facility down the road was already A, full, or B, more expensive? So obviously, a lot of customers, really, it's a sticky business. The other thing that we like about storage is you can add a lot of different sources of revenue. So we do propane ancillary revenue. We also roll out tenant insurance as part of our brand standards. Tenant insurance is a revenue share. So if you give the 500 unit example, usually insurance policies are about $8 a month, and we take about 40 to 50% of that revenue. So on 500 units in the first month, we usually increase NOI by over $1,000 a month just by adding tenant insurance at the property. We require tenant insurance. However, we can't require that they use our specific tenant insurance, but we can require that they do use and insure their belongings. Merchandise sales is a great provider of convenience and also a revenue source that we put at all of our properties as part of our brand standard. Any access land you can put boat, vehicle, and RV storage on, which we frequently do. Self-storage auctions can be profitable sometimes, but also a way to just get a paying tenant into your facility. We do ice and vending at some properties as a way to drive convenience to a store. P.O. boxes, again, another convenience item. Notary services and FedEx and UPS drop. We're trying to make our properties and our store locations a place of convenience. So if you come in there, you can get something notarized, you can ship something, you can check your mailbox, and additionally, you can also rent a U-Haul truck. So U-Haul truck rentals provide a great convenience. Sometimes they don't make a lot of sense from a revenue generation perspective. We're basically doing a revenue share with U-Haul, so we're managing the cleaning and turnover of the trucks. We don't manage the maintenance, nor do we own them, but we share the revenue in the truck rental. It's a really hard business to make really profitable because it's pretty labor intensive. However, having the U-Haul trucks at your store location really provide a convenience to the customer. Cell phone towers. The case study that we're talking about today actually came with a cell phone tower. And it's essentially a triple net lease that can make great cash flow with really without taking much space in the property or having any maintenance expenses associated whatsoever. So what kind of deals do we want? What kind of investments do we look for in our portfolio? So the picture on the top right there, that's an 11-unit self-storage facility that came with 2 acres of expansion opportunities. And if you've seen one of my presentations before, I do a complete case study on that property where we added 40,000 square feet. So we love self-storage facilities that have inefficient operations that we can provide a lot of sophistication to and increase revenue that way. We also like the fact that it came with vacant land where we can build additional units because the market commands that demand is there. We also like expansion or ground up projects. So we'll take a complete greenfield of trees and dirt, and we will put in all the infrastructure, utilities, and build a brand new facility. That picture down on the right-hand side is actually one of our facilities that we're building just south of Seattle, Washington. We're building 755 brand new units, or about 110,000 square feet. And that facility is actually slated to open in about 3 weeks, which is really exciting. So if there's one thing that you take away from today's presentation is make sure you have a team or consultants in place to ensure that you can complete your business plan. Self-storage, while it's growing in demand and it's great, it also can be oversaturated in some markets. And I like to say that self-storage is a 3-mile business where your customers aren't going to drive 2 hours to your property, or they're not going to relocate to an area because it's more convenient to their self-storage. So pretty much the population that you have within a 3-mile drive time is your customer base. So within that ring, you've got to figure out if there's enough demand, population growth, what's the saturation, are there any construction permits in the pipeline, what's the job growth there, and can you get the rental rates that you're really trying to achieve in your business plan? So we have a team of 3 people that all they do is do research. So Lindsay, Tristan, and and Lindsay, Tristan, and Max, sorry, also are basically just focused on the demand. So they look at everything that you can possibly imagine in a market. So Tristan, for example, will go and mystery shop all the competitors in person to verify occupancy. Max will go and call all the competitors and look online at rental rates. And then we pull data within a market to see how many drive-by cars there are in a particular facility location. So it's just really it's really important to understand the actual data behind determining if a self-storage business plan is effective or not. This is where we look. You might say that we look far and wide, and we absolutely do. And that's because self-storage, there's only 55 or 60,000 facility locations. And it's really hard to get the deal flow if you're not looking in a lot of different markets. So this map is available on our website at spartan-investors.com. And these are all the markets that we play in. This is where we look. And, you know, a multifamily operator may be able to focus on one or two markets. And that's because in one or two markets, you might have as much deal flow as storage does by looking at 150 markets. It's very hard to find enough deal flow if you're not really expanding your search criteria. So these markets, we like them because they're high growth areas, high jobs, good rental rates, and generally low saturation. So when we find a property and we bring it into our mix, this is our property operations team. And you can see just some of the line items that we use in underwriting to underwrite our properties. So we have revenue, and on the right-hand side, we have the expenses. So these are all the things that you might typically see in an underwriting file for storage: lock cut fees, late fees, admin fees, U-Haul commission, propane exchange, etc., in addition to your top line stuff, which is essentially your storage rents and your RV rents. Some expenses that you might have are on the right-hand side here: insurance, landscaping, payroll and fees, etc. And I would say if you're looking at a self-storage property, the two things that are going to swing wildly in your operating expenses are your property taxes and your insurance, because they're very dependent on your store location and also dependent on the county that you're operating in and what their taxable mill rate might be for the property. So we have an entire acquisitions team that scours the markets every day, makes phone calls, reviews deals on market, off market. And in 2020, the team looked at 1,237 deals. And those were deals that were analyzed, brought across our desk, considered for purchase. And that resulted in about 24 LOIs where we sent out a letter of intent to buy the property. And we closed 9 new projects in 2020. In 2024, the team has an aggressive campaign. We're going to actually buy 24 facilities in 2021. So far, we've closed 2 facilities, and we have another 10 or so under contract to close in this quarter. And overall, we're looking to add about $150 million of total project cost in 2020. And the team here does a great job of doing that. So today, we're going to talk about the case study for the Tyler Longview portfolio, probably one of my favorite transactions in 2020. And it was a 4-property portfolio, 2 properties that came from in Longview, Texas, and 2 properties that were located in Tyler, Texas. So I've listed there the number of units, and the total square footage was about 250,000 square feet. It amassed to about 1,800 units spread across the 4 properties. And the total purchase price was $8 million, which was a great price for this portfolio. It came with $560,000 a year of in-place net ordinary income. So that was net profit on the properties. And we closed the properties in September of 2020, which brought its challenges, because if you remember 2020, we were right in the heart of COVID. And leading up to this acquisition in 2020, we were doing our due diligence during the heart of COVID. So it made the process extremely challenging and difficult. The other thing I wanted to point out was originally this property was marketed to us as a 3-property portfolio. And the bottom right one there, the attic self-storage, was actually added during our due diligence process. We asked the seller if they owned any other properties in the market, and they said they did, and we convinced them during the sale of the portfolio to add that 4th one in there just to make those economics that much better. So this is Tyler Burke. He was our acquisition lead on the portfolio purchase, and he's going to just kind of recap what it was like to buy a property in the middle of COVID.
Today's featured property is a Tyler Longview portfolio, which represented Spartan's first portfolio purchase in 2020. We went under contract at the onset of COVID, and I never thought this would happen, but our team literally jumped in an RV and drove the 1,200 miles to Tyler, Texas. That's never been done before, and I never thought we would do that, but it really just shows our dedication and commitment to get the deal done. What I really loved about this property was when we initially went under contract, it was just 3 properties. But after review and a good market study, we included the seller's 4th property, which increased commissions to the broker and also helped the seller achieve his maximum net proceeds. We're excited about this first portfolio, and we're looking for more portfolios here in 2021 and moving forward. If you have a lead on one, drop me a comment, send me a message, shoot me an email. We'd love to work with you.
Okay, so very interesting times, and much respect to the team for hopping in that RV and driving 14 hours down to Texas. They didn't want to fly due to COVID. Didn't blame them. We wanted to keep people safe and kind of limit exposure. So the RV was a great way of accomplishing that mission. So what do we like about this portfolio? You know, what are the things that really attracted us to the deal? Number one, it had day one cash flow. The way we purchased the property and the way that we structured the debt, it cash flowed from the day we bought it. The other thing that we liked, that there was low REIT presence in both of those markets. You know, we don't really like to go in the primary markets that are oversaturated with publicly traded companies or otherwise the REITs, such as Public Storage, Extra Space, Life Storage, CubeSmart, etc. We like to go in markets where we can be the best operator, and those markets were. In this instance, there wasn't very many REITs in the market. We also like that it came with high physical occupancy. So if you blended the average occupancy across the portfolio, is about 90%. We bought from an out-of-state owner who had basically taken his foot off the gas. He lived in California, and when we toured the properties, the offices were a mess. The operations were failing, and in regards to roofs were leaking, drive aisles were torn up. One of the facilities, the woman had numerous cats in the office, and it smelled really bad. And there was a lot of work to do. But yet the portfolio was still 90% occupied, so it really showed the demand. We also liked that it came with 3 vacant parcels where we could add additional units. And lastly, the economies of scale. And this has really pushed us to focus solely on buying portfolios because of the economies of scale that we can get with hiring a regional manager and the efficiencies across the portfolio that are achieved. So you might be wondering, how did you structure the financing? How did you go about taking down this deal? So the first thing that we did was we sought out debt. So we sought out $5.7 million of debt. And the little stack over here to the left, I'm going to stack up the capital to show you kind of all the capital that was brought in and how it was all used. We also made sure that we had $1.3 million available for construction debt so that we could expand additional units. And lastly, we raised about $4 million of equity from our investors. So we go to market with our private investors to secure that equity. So when you look at this, it's an $8 million purchase, but $11 million is what we needed in totality to complete our business plan. That represents an $8 million purchase, $1.3 million to expand the properties, $1 million of initial improvements. This is roofs, drive aisles, making repairs to the office or office renovations, swapping some doors on some properties. And then we put $300,000 in our operating reserves. And then we have about $400,000 in closing costs and project management fees. So let's talk about where that money came from. How did we get a loan? What was the lender? What was the terms? So first, we'll start with the equity. The equity investors came from our private investor network, and the investors got a 7% preferred return with a 17.9% target annualized return and a projected 5-year hold. The construction debt was also raised from private investors with 1% paid at closing and 7% per annum paid monthly. And lastly, the debt for the acquisition of the property was a purchase loan, And it was actually came from a life insurance company that provided the debt for the property. There's a lot of different ways you can finance these properties. Life insurance money, institutional debt, conventional debt, your local lender right down the street, and private debt, which Spartan does. The leverage was 57% loan to cost. We achieved a 3.75% interest rate in a 25-year amortizing loan. So what's the first thing that you do in a market to understand if you can raise rents and understand what value potential exists? So the first thing that we did was we studied all of the market rents in Tyler, Texas. So if you see this slide here, you'll notice that there's two properties on the bottom left there, the Attic, which we purchased, and Highway 155, which we also purchased in Tyler, Texas. And what we did was we said, okay, what are all the other competitors charging? And do we have the ability to raise rents? So the Class C market, these are C facilities. These are rundown, dilapidated, unmanned, unattended to facilities. The average rents were about $76 a month. And the Class B market, decent facilities, well run, but not your premium glass, nicely landscaped, brand new facilities, was about $88 a month. And the Class A market was about $141 a month. So when we looked at this, we said, okay, how can we compare ourselves? We're going to add drive aisles, roofs, new doors, office renovations, but realistically, we're only going to take these C-class properties that we're buying, and we're probably going to make them only worthy of being comparable to a B-class property. So we looked at the B-class market average, and we saw that there was about a 17% increase just in the marketed rents that our facilities were currently charging. In the Longview market, we noticed the same thing. There was about a 25% increase in potential on our Gilmer property and about a 21% increase potential on our Metro property as compared to the Class B market. So this is after we've achieved our initial improvements. The other thing that we look at is, okay, well, they're charging those rent, but are they actually getting those customers? So we looked at the Longview portfolio occupancy. So this is the two properties that we bought in Longview. And our properties in that market were currently 90.4% physically occupied. But the market was 95% occupied, showing that there was strong demand. We also looked at the Tyler market and noticed that our properties that we were purchasing were 91% occupied, and the market occupancy was 92% occupied. And you're probably wondering, okay, so what's your physical occupancy now since you've taken over? You've made all these improvements. There's been disruptions, there's been rent increases, there's been a lot of auctions, etc. And currently we're 81% occupied physically. And you might think, why did your occupancy go down 9% since purchase? And we're going to get into that. And you'll see that physical occupancy isn't always an indicator of the value that you've created or the current status of the portfolio. The other thing that we do is a feasibility study. And we wanted to understand the demand that surrounded these four properties. So we did a feasibility study, and we basically looked at the current saturation of demand in the market to determine how much surplus square feet existed at each property. And you can see there, we won't go through each one. We also looked at the population growth in the state of Texas and in the specific markets that we were looking in. And we looked at the employment numbers. And we like these numbers. It was a high growth market and great income increases as well. So when we put the property under contract, that was kind of the next step. Is we liked the market, we liked kind of the business plan, and we put the property under contract for $8 million, all four properties. And we gave ourselves a 42-day due diligence period. This is to get all of our survey, site selection stuff done, environmental phase 1, geotechnical at the expansion, go through zoning, and in totality, complete our 680 due diligence point checklist to make sure that we can actually accomplish our business plan. We also deposited $75,000 of earnest money that went hard at the conclusion of our due diligence period. So what did we find? So during those 42 days, you discover quite a bit about a property. We found that the occupancy was 90.3% physically occupied. We found out that 17% though of the customers were delinquent, so they weren't paying. So even though you had people physically occupying the property, you had 17% delinquent customers. We found that when you considered what all of the tenants were paying and how much you could move the needle to market rents, we were 36% below collections based on the market. So let me give you an example of that. So let's say the customers were paying $100 on average, but 36% above that number was what the market was actually charging. So we saw a huge NOI increase potential on the portfolio. We also found that the markets were 90+% occupied. So what did this mean? Financially, it meant that we saw an opportunity to increase NOI by over $400,000 per year over time. And we also thought analyzed that with the current cap rate, NOI divided by cap rate equals value, that we would move the valuation of these 4 properties in totality up $6 million if we could accomplish our business plan. But let's talk about the physical occupancy, the study, or the physical due diligence, the studies. We found failing roofs. We found outdated retail offices that needed complete renovations. We found old swing doors, which isn't very exciting in Texas because it gets pretty windy there. And if you have a swing door that opens up that's really rusty and now it's blowing around in the wind, and people really kind of anticipate and expect the roll-up door. We found faulty drive aisles. We found cracking and, just not very well-paved facilities. And we also found that there was vacant room to expand, and we started our due diligence on that property. But in totality, we determined that there was about $1 million needed in repairs to take our properties from Class C properties to Class C properties. Class C properties to Class B properties. So then we looked at the rent roll. We, really analyzed, the opportunities in the rent roll. And, as I kind of mentioned earlier, we saw that in totality, there was about $447,000 per year gap between current customer collections and what the market potential was giving us. Then we looked at the vacant land, and we found 3 vacant parcels. One was at the attic self-storage. This parcel was right at the frontage. And we're actually considering expanding the attic right now. We're considering expanding it by as much as 60,000 square feet. Then we found Gilmer Road self-storage to have a vacant parcel. And we didn't really have a whole lot of time to analyze this parcel. And we ended up just taking these 2 parcels and not even putting any value to them because we had to close on the property somewhat quickly. And we just didn't have enough time to position these parcels to our investors to give a projected return. So we said, you know what, these are just pure cherry on top upside parcels. But at the Metro, it was a slam dunk. It was really nice graded property in the back. It was going to be easy to add storage. And we underwrote that we were going to expand that property by about 25,000 square feet. So what do we do to expand a property? So here's all the existing buildings on the right-hand side, and you can see in the lower right-hand corner of the picture, that is our unit mix that we're planning on expanding. We break ground on July 14th. So there was a 25,000 square foot expansion and about a $1.3 million construction budget. We always overestimate. This includes contingency and a pretty healthy budget. We're actually coming in right about $41 a square foot for just your classic single-story construction with, kind of slab on grade foundations and standing seam roofs with good dirt. The dirt really can provide a lot of variability in construction costs. We gave ourselves in the business plan 6 months to build it and 20 months of lease up time. So plenty of time in the underwriting. You don't just build these and fill them up overnight. Sometimes you do, but you can't plan for it. You have to make sure that you have the runway to get that lease up time. And then that would increase our NOI by about $108,000 per year, or otherwise add over $1.7 million in value to the 4 properties. So in totality here, we conservatively underwrote increasing collections $400,000 per year over the entire business plan, so over 60 months. So we gave ourselves plenty of time to get in there, friction, improvements to the property, rent collection raises, because nothing happens overnight. We underwrote expanding or worsening the cap rate. So right now, cap rates in storage are plummeting. That's really good if you own them. It's really bad if you're trying to buy them because that means they're getting more expensive. We planned a 6.91% cap rate exit. And for those in storage, that is probably unrealistic. you're looking at a much better cap rate now for exits. Self-storage portfolios are trading in the low fives. Sometimes they're trading in the high fours. So that's a much higher valuation. We wanted to be conservative and make sure that we hit our target. So we planned a 6.91% exit. And we didn't put any value on the 2 vacant parcels. And again, the reason why we didn't do that, the ones at the Attic and the Gilmer, is because we just didn't have enough time to figure out what we wanted to do. We wanted to focus on this deal just working as a self-storage portfolio and not anything else. We planned a 25,000 square foot expansion at the Metro self-storage, and we planned for heavy customer friction during the transition and rental increases. So we planned on people moving out. We planned on people not, accepting the rent collections, and we planned that in the underwriting file. And for anybody who's planning on doing that, I would conservatively make sure you plan to have customers leave your property. And we projected a 5-year hold. So a lot of people ask about taxes, and I think what's great about investing with your self-directed IRA is that you get that tax shield, right? Because it's within a retirement account. But for those that invested with cash, and IRAs, you're provided with an K1 at the end of the year, and the property comes with depreciation, and that means that you usually have losses in year 1 due to depreciation because you do a cost segregation study, and you're allowed to use something called bonus depreciation. And so on this particular asset, this is a real K1 from the actual property. An investor who put in $50,000 lost $10,222 in the first year, and you can see that down there in their capital account statement. Usually, those losses can shield taxable income from distributions for the 5-year hold. But obviously, as you know, there's recapture tax upon sale. It's usually a flat 25%. And like Nicole said so eloquently in the beginning, I'm not a CPA, I'm not your financial advisor, and definitely do your own due diligence and consult with a CPA before making any investments or buying your own facility or anything like that. Make sure that you talk to a CPA to understand the impacts on your personal situation. But I did a new slide on depreciation. I really had a lot of fun with this because depreciation is just this magical thing that happens and nobody really never really explained it to me. And we hire a cost segregation company to come out to the property, and it's an engineer that takes a bunch of pictures and kind of looks at all the components and how the buildings were constructed and compiles a study to figure out what you can actually depreciate and what you can put into an accelerated depreciation schedule. So I mentioned that for a $50,000 investment, there was a $10,222 loss that was achieved. And, it's great because it's cash in hand, because there's still distributions and there's a loss on paper. And here's how it works. So a cost segregation study expert will come in and say, okay, what did you pay for the property? And in this case, it was $8 million. And they're going to determine, okay, how much value goes to your land? Because land is not depreciable in a facility. Then they're going to break it up into the second thing and say, what does the IRS deem as 5-year property? This is things like landscaping or maybe appliances in a residential home, etc., that the IRS allows depreciation over 5 years versus the traditional 39-year. Then they look at 15-year property, and then they say, okay, how much of this is permanent and goes into the 39-year bucket? So if you break all that up, that equals $8 million. And this is how they break up and segregate the purchase price that you paid as the new buyer. And so obviously that totals $8 million. So then they say, okay, well, how does this flow down to me? How does this benefit a passive investor or an operator or an owner of a facility? And you say, okay, well, to get to bonus depreciation, which came out of the 2018 tax code, it allows you to take all the 5-year property and all the 15-year property and take it in the first year for depreciation. So if you add that up, that's a $1.566 million loss in the first year, just right off the bat. And that flows to the partnership and gets handed out in the partnership. But you can also take the 39-year property depreciation. You can't take it all in the first year, but you can divide that by 39 years and take $144,449 every year in depreciation. So if you add those two together, in the first year, we wrote off $1.7 million of losses. which is fantastic because you don't pay any taxes in that year. So with all this going on, we've owned the portfolio now for about 8 months, and there was another facility that popped up for sale in Longview, Texas. And we were interested, because it was a nice property that was $1.8 million. So a great deal on the purchase. And it was I-20 Ranch Storage. We closed on this property about 3 weeks ago, and it was poorly operated. We went to the property. The manager wasn't very friendly, and it was 45% occupied, but the market was pretty much fully occupied. So it obviously was clear that they weren't doing something right. It also came with vacant land to expand. And if you look at the bottom left-hand picture there, it's right on I-20. So there's about 20,000 cars a day that drive by this facility, which is what we love. We also thought, we already have management in the area. We already have a kind of a third office in Longview because of our presence there. And that's where our regional manager already lives. So we thought, we could have her go over and take over the property without much added expense in Longview. And when you looked at what we could do to the property, is we could add, once it's fully occupied and leased up, it would add about another $182,000 a year to our bottom line in NOI. Or in other words, that's about a $3.2 million valuation once we turn it around. So a $1.8 million investment for a $3.2 million potential exit was great terms. So then we thought, how are we going to buy this? Are we going to just buy this one off? Are we going to roll it into the portfolio? How are we going to do an acquisition of this property? So we looked at our financials and we were like, holy cow, this portfolio is doing so well. It's exceeding our projections by over $30,000 per month already. And so we calculated, okay, well, what if we just put 100% debt on that new acquisition? What would that do to our monthly cash flow? So we said, we'll use excess cash flow to pay that additional debt to acquire the facility at no dilution of equity. And we said, well, what is our current LTC? Because we don't want to over leverage. We're not, we like to keep our leverage below 70% across the portfolio. Sometimes a lot less than that based on our purchase price. And the current portfolio loan to cost was 57%. So it was well leveraged to begin with. And if we put additional debt on the property to take down the new one, it would increase our loan to cost to about 66%. So very healthy leverage. So then we decided, okay, where are we going to get the loan? So we called our existing lender and we said, hey, what do you think? And they said, yeah, we might be able to roll the property up once you stabilize it later on this year. So we raised debt from our private investor network. And we did this with a first position against I-20 storage. And then we have the loan paid by the portfolio. And remember, it has that $30,000 of extra cash flow. So we could offer great terms. We offered a 1% closing point and 7% per annum paid monthly. So great investable note with a first position and a personal guarantee, but also not a huge added expense to the portfolio. I believe when you blended the 3.75% interest and the new debt at 7%, the weighted average was about 4.25%. So it really didn't increase our effective interest rate all that much. So we're exceeding projections by $30,000 a month. The new debt would cost about $12,833 a month. That's taking the $2.2 million needed to buy the property and multiply that by 0.07, divide by 12. And this opportunity allowed us to add $182,000 a year of NOI, or increase our equity in the portfolio by over $2 million. And it didn't require us to do any capital calls. It didn't require us to dilute anybody's equity. It was simply just the portfolio's strength to consume this property like a shed in a with a tornado in a fight with a shed. I mean, it was an easy takedown. So we closed it. It closed on, I believe, April 26th, so a few weeks ago, and it was brought into the portfolio. So just to kind of summarize, this started off as a 3-property portfolio, but by the time we closed, it was a 4-property portfolio for $8 million. But it's now a 5-property portfolio with the additional property in Longview. And The original purchase price was $8 million, but now it's the effective cost of all the properties was about 9.8 because I-20 Storage was purchased for 1.8 million. And you might be thinking, well, you bought it for 1.8, so why did you raise 2.2? And that's a great question. We can go back to the drawing board on sources and uses, and we're going to amend this, and we're going to say, okay, let's go to the bottom left here. We're going to increase our debt to 7.9, which is going to take our total project cost to 13.2. And how are we going to spend this additional 2.2 million? Well, we know that we're going to increase our purchase price from 8 million up to 9.8. So adding the 1.8 million. And then that property needed a new roof, it needed new concrete. And so we're going to increase our improvement budget by $200,000 to slap a new roof on the facility and do some other repairs. And then the property is only 45% occupancy. So we really want to be comfortable with our operating reserves. We want to increase our operating reserves. So we're going to do that by about $100,000. And then there's going to be some cost to close it and manage the project. So we're going to increase that bucket of money by $500,000. So this is the new sources and uses to fold that new property into the portfolio. So just some more assumptions for underwriting. For this particular asset, this portfolio, we put in a 51.3% EGI ratio, so expense to gross income ratio. The reason why we did this, we usually underwrite about 40%, but when you consider you've got to deploy about $1.2 million of fix-up cost, you're going to have some staffing to do that. So we were kind of a heavy payroll load and a lot of labor intensity to get this done. The portfolio will normalize out to about a 40% EGI. And if you're wondering, what is an EGI? Well, if we bring in $1 of revenue, that means that we spend about 51 cents in cost to manage, to get that revenue. So that's expense to gross income ratio. We assume that these facilities are only ever going to be 91.42% physically our max economic occupancy, meaning that we're never going to get it above 90% total, just to be conservative. And we assumed a 25,000 square foot expansion, and we targeted about a 6.91% cap rate exit, which again, in today's market with storage, it's in the low fives for portfolios. I mean, you can find a self-storage facility in the middle of nowhere for a 10 cap that needs a lot of attention and doesn't justify a manager and the financials. But when you get into these larger portfolios, the cap rates go down into the fives and the high fours. 5-year hold in our underwriting assumptions. So kind of overall, the original plan here, it's changed quite a bit. But if you remember, we had $560,000 of existing NOI when we bought the 4 properties. And we planned to raise the NOI by $403,000 a year through operational efficiencies. That's a call center, cleaning up the offices, and taking those properties from C-class properties to B-class properties. And then we said, okay, we're going to increase NOI by $108,000 per year by expanding the facility by 25,000 square feet. We put no value on those other 2 parcels. And so that would bring our NOI, once we're done after 5 years, to $1,071,000 per year. And if you value that, you take that $1,071,000 per year and you divide that by a 6.91% cap rate, that gives you a total value of 15.5. So if you recall, $11 million total project cost for a $15.5 million value at the end with cash flow along the way. So a great project. But here we are at month 8. So how is it going? What are our current projections? How much rent have we increased so far at month 8 out of 60 in the business plan? Well, we all started with the same NOI, and we've increased annualized NOI by $208,000 a year, and forever increasing 8 months into it. So we're on track to hit our goal of 403 by month 60. And we still are we're planning to break ground on that expansion in July of this year. So we're planning on adding that 108,000 per year in NOI. And we're still not putting any value on those 2 parcels, although we're evaluating building retail on one and also building an expansion of climate controlled units at the attic. But then we have this new bonus thing that just popped up, which is the new I-20 self-storage acquisition that we picked up that will have a NOI potential of 183,000 per year. So when you summarize kind of where we're at with the new projections, we're looking at hitting NOI 1.059 or a 15.325 valuation. So if you can imagine adding another 200,000 to that, we're planning on landing somewhere a couple 100,000 above where we projected to be in the plan. But here's the reality. Like I said, portfolios are trading at in the low fives, high fours. So if you put a 5.9% cap rate valuation on the portfolio now, we think it would trade close to $20 million in its current state. So tracking the business plan, I highly encourage you, if you're getting into self-storage, you've got to bookmark yourself against what you thought was going to happen versus what actually happens. So what we do is we track revenue pro forma versus actual, and you notice it kind of bounces around quite a bit. My apologies. We do cash accounting. We're about to switch to accrual accounting method, and we also are tracking this month by month. So sometimes it bounces around a little bit, but you can see the dashed line that gives you what we thought, and then the hard line which gives you what actually happened. So we track this just to go back and kind of benchmark ourselves and make sure we're dialing in better estimates for our future acquisitions. So there's our expenses. You want that hard line to be below the dash line. So you can see it's kind of averaging to at or below what we thought, which is good. And then we track distributions. So we say, based on a 50K investment, this is where we think distributions are going to be. And then this is where they actually were. So you can see in October, about a 3% cash on cash distribution for the month. November, there was about a 7%. December, there was a 4%. And then the last couple of months have been 7%. Just recently, cash flows increased to a 9% cash on cash per annum paid monthly. And we're doing quite a bit better than projections there. We also do net ordinary income. Now, net ordinary income is different than net operating income. Net operating income is simply revenue minus expenses. Net ordinary income is the net. So that is the bottom of the P&L. That is everything included: property management fees, financing, any travel to the property to check up on things. So that's really the bottom line performance. So you can see we're well over just shy of about $30,000 a month of net ordinary income. Net operating income is about $45,000 ahead of projections, which is one more step up in the P&L. So in summary, 5-property portfolio, about 1,800 units, and expanded that to about over 2,100 units. And we're adding value to these properties by implementing sophisticated operations to increase NOI. And by increasing NOI, we increase the total portfolio's value and the cash flow. Our plan is to expand existing facilities and to improve the existing facilities that need a lot of improvements. So we have that $1.2 million budget for improvements. And overall, the takeaway here is that we prefer portfolio deals now due to the scale and the strength. And another thing that somebody recently pointed out to me, it's kind of like almost like a mutual fund where if one property is not doing as well, the other properties may bring it up. So it's a great opportunity. So we love to share information about case studies, the state of the industry. If you're interested in that at all, we have a newsletter that comes out quarterly that we talk about self-storage. We talk about the deals we're looking at and anything that might be interesting in the self-storage space. And so that's our newsletter information if you wanted to join that. This is Ted, Lauren, and myself. We head up the investor relations team at Spartan. And I left some time for questions, and I think there's a few. So I don't know how we want to do the questions, but hi, Nicole.
Hey, Ryan. So I would say thank you so much for joining us. That was amazing information. And as someone who has a storage facility in 2 states, I would say that it's probably a pretty good business to be in. We moved from Louisiana. I think it'll be 3 years this summer, and we still have at least one storage facility there, and we still have one here in Houston that we
great.
unloaded.
Yeah.
So good business to be in.
Is it because of life event?
Yes. So my husband started an oil company here in Houston. So we moved from Louisiana to Houston. And we have not yet unpacked all of our things in Houston or gotten all of our stuff from Louisiana yet. So
Makes sense.
the
Yeah.
storage facilities have been great for us. And we have two boys, 8 and 11, and I have not been able to get rid of their stuff from when they were little. And we're just mounting more stuff as they're in school here. So we have Louisiana memories, Texas memories that I just can't seem to get rid of. So a great platform to be in. We have questions, to say the least. We have over 20 in the Q&A. We have them in the chat box. They are they're really everywhere. So I would say the biggest question that we have is if they only take accredited investors. From what I see from Ted Green, it looks like the answer to that is no, but I'm going to let you answer that one for sure.
Yeah, sure. No, we take both accredited and sophisticated. And sophisticated means that you can reasonably assess the deal, and yet you have a pre-existing relationship with Spartan. So on our website, you'll see that you can say you're not accredited, and then it says, okay, well, we need more information, and then we just need to have a call with you and meet you to determine that level of sophistication. But we do, from time to time, do non-accredited offerings. Primarily, we do accredited only, but we do we do take both.
Okay, great. And do y'all have a private fund to invest in?
Yeah, so we do our projects deal by deal. So we don't do a self-storage fund, but we allow investors, like Tyler Longview was an opportunity that was presented back in the summer last year, and it, you say, okay, I can invest in that specific project. So we do it deal by deal.
Wonderful. Thanks so much. We have tons of questions too on kind of what you do with the land or how you look at the land. Like, will you do just distressed properties? Will you look at new projects altogether?
Yes, both. Yes to both. So we do everything from core plus, kind of a stable, steady Eddie property, to we need to build it from scratch and do all the entitlements and get the zoning and get the approvals and hire the contractor and build it out of the ground. So we do pretty much the gamut. Okay,
perfect. What does it take to invest with Spartan? We have a lot of interest in Spartan, so that's great. Let's see, what was another big question that we had? Range of operating margins for self-storage. Would you be able to speak to that?
Yeah, that's a great question. We look at our properties at the project level. So in totality, we look at a 30% value spread in our business plan, from soup to nuts. So like in Tyler Longview, we were in for 11, out for 15. So that would be more than a 30% value spread with cash flow along the way. But when you look at a property, it has a cap rate. So, just imagine you bought something all cash. So if you bought a property with all cash and it had a 6% cap rate, so completely unlevered, which, who knows, maybe you want to buy something unlevered, but that'd be a 6% annual return. That's what a cap rate means. So if it was a lower cap rate, you'd pay more and have 5%, or lower. So that would be a traditional going in return. Now, what we do is, we do care what the cap rate is going in, but we're less concerned about the cap rate going in and more concerned with how we can revert that cap rate into a better, higher cap rate based on the value we can deliver over the expansion and the improvements. So that the range could be, I'm sorry to say, it's kind of all over the place. It just depends on the deal, depends on how you can reposition it.
Wonderful. One more thing that this question I thought was really interesting. Has the price of lumber affected construction, or is this really kind of a steel construction?
It's steel. We've only actually ever expanded one property with lumber. Kind of weird. We built in Aspen Park, Colorado, and we're doing steel interior like 8 steel, but the county actually wanted the expansion to match the existing, and the existing was wood construction. So we are building with that. So obviously, with like anybody, we're not immune, unfortunately, to this insanely high cost of lumber. Although we don't really use lumber on most of our projects. Steel prices have gone up, but we've been able to overcome that by buying great projects that have the rent that just still justify the construction. And any projects that don't have that, we just have put those on hold. So, but that's not very many. It's primarily we're still able to move forward.
Okay. I think we have time for just a couple more questions. I thought this one, these kind of both go together. One was asking about like the contactless or unmanned model, and the other was asking about the contactless, like electronic systems or the kind of traditional.
Yeah. So
could you speak to that?
absolutely. So I love this question because everything in storage should be automated. But that doesn't mean you can remove your manager in all cases. So if you're buying a small facility that can't justify a $30 or $40 or $50,000 a year manager, then of course you have no options. You have to automate it. And that might mean that you have to step in a little bit. Now, I encourage anybody looking to get into storage to automate, and the tools are available to do that. So all of our facilities are fully automated. Some are unmanned, not by choice, but by the fact that we can't justify an employee to actually physically be there 40 hours a week. And not every facility needs that. So it really just depends, but everything is automated. We have a call center, a website, online bookings, 24 hours a day. We've streamlined that process quite a bit. So storage is a very automated space, and I encourage you to automate.
Wonderful. All right, Ryan, let's see. All right, I'm going to fit in one more question since there really are just so many. All right, everybody, don't get mad if I don't pick yours. And I have put the website.
I'm happy to respond.
Wonderful. Thanks so much. And I put the email address that Ted gave in the chat box, guys. If I don't get to your question, and I've put the email addresses for Kurt and I as well. Let's see. I think I've gotten to that one. All right, this is going to be the last one, guys. What percentage of equity is Spartan put in alongside outside investors' projects?
Yeah, so in this case, we brought the $5.7 million personally guaranteed loan, and then we invest in all of our projects. As a percentage, I don't know. We don't have like a set percentage. It just depends. I mean, if it's a small raise, we still put in the same as it being a large raise. But we bring the debt, and I think that's important consideration because we're signing on millions of dollars of debt in our investments.
All right, perfect. Well, I mean, really, the questions are just pouring in. So the information that you gave is really, really valuable. And we really appreciate you being here this Saturday with us. And thank you, everybody, who joined us with us this Saturday. Thanks so much for joining on Self-Directed Saturday. I'm going to make sure that, let's see, before we go, that everybody's information is in the chat box. Kurt, if you'll help me with this.
Yeah, I've left it on there, and
perfect.
I got something real quick. There's one gentleman that's asked a lot of questions.
Okay.
Todd, and they're all kind of, to me, they're all kind of tied into the same thing in terms of, are you buying existing or do you guys do ground up? And can you just speak to that real quick? And I want to read two more of his questions because this guy literally asked like 7 questions, so I don't want to leave him hanging.
Yeah.
So I think we talked about margins of operating. We do ground up and existing. Ground up should produce a lot more return than existing. And if it doesn't, you're overpaying for ground up. The cash flow from operation, NOI is impressive, but what about cash flows? Yeah, it just depends on how you lever it. I mean, if you pay all cash, you get all that cash flow, right? If you pay with leveraged, then it changes that. Average investor returns just depends on the risk reward return. It can be anywhere from 8% annualized all the way up to, if you're doing ground up, 25% annualized. Insurance, I realize tenants have to carry their own. How expensive? We're underwriting about 25 cents per square foot is our portfolio right now. Sophisticated operations, Sherry, is just call center, website, SEO, marketing, digital advertising, paying attention to the Chamber of Commerce. At your ribbon cuttings, you're inviting the politicians. You're doing stuff that's really moving the needle. To invest with Spartan, our minimums are $50K. Under Reg D, we are not registered. When you do an exemption to raise capital, you are not registered. You are filing an exemption, and we do an exemption under 506B and 506C. Okay, I think I knocked out a bunch.
you so much, Ryan. I really appreciate
Yeah, no
that.
problem. Yeah, no problem at all.
I know, guys, there were so many questions. I tried to get to as many as I could that kind of had a general vibe of the group. So I left the information in the chat box to get in touch with Ryan and to get in touch with Kurt and I. Thanks so much, guys, for joining us today on Self-Directing Saturday. We'll be here next Saturday, of course, same time, same place. Thanks again to our special guest, Ryan, who gave us so much valuable information. I haven't seen this many questions in a chat box hosting in a really long time. So we really appreciate you being here. What an amazing topic. Have a great weekend, everyone, and we hope to see you soon at our other events. And have a wonderful weekend, guys.
Great. Thanks, Nicole. Thanks, Kurt.
Thank you.
Everybody, Quest. Okay. All right.